You've probably heard this before. You can only write off business losses for 3 years. That's what accountants say. That's what your neighbor says. That's what Facebook tax experts say. It sounds official. It sounds legal. It sounds terrifying. There's just one problem. That rule does not exist. Today, I'm going to show you what the IRS actually says and why most people completely misunderstand the 3-year rule. Section 1, where the myth comes from. The confusion comes from Internal Revenue Code Section 183, the hobby loss rule. Here's what the IRS actually says. If your business shows a profit in at least 3 out of the last 5 years, the IRS presumes it's a business. Read that carefully. It does not say you can only deduct losses for 3 years. It says if you have 3 profitable years out of 5, the IRS automatically assumes you're in business for profit. That rule works in your favor. Section 2. What happens if you don't hit 3 out of 5? Here's where people panic. If you don't have 3 profitable years out of 5, nothing automatic happens. You are not banned. You are not disqualified. The IRS does not shut you down. It simply means the IRS can look closer and ask, is this really a business or is this a hobby? That's it. Section 3, the real test, the 9 factors. If you don't meet the 3 of 5 presumption, the IRS looks at facts and circumstances. They examine things like, do you operate in a business-like manner? Do you keep records? Do you have a separate bank account? Do you market consistently? Do you change strategy to improve profitability? Do you have expertise? Have you made money in similar ventures before? Notice something? This is about intent and effort, not a calendar limit. Section 4, the dangerous oversimplification. The phrase, you can only deduct losses for 3 years, is a shortcut explanation. But shortcuts in tax law create fear, and fear creates bad decisions. Some people stop claiming legitimate losses, shut down good businesses, or never start in the first place because they think they'll get in trouble after 3 years. That's not how the law works. Section 5, when you actually have a problem, you're at risk if you show losses year after year. You make no changes, you don't track income, you don't market, you don't try to improve. If your business looks like, I just enjoy this and it saves me taxes, that's when the IRS may reclassify it as a hobby, and hobbies cannot deduct losses against other income. That's the real danger. Section 6, real world example. Let's say you start a home-based business. Year 1, loss. Year 2, loss. Year 3, loss. Year 4, small profit. Year 5, break even. Under the myth, you're in trouble. Under the actual law, you are running a developing business. The IRS looks at the total picture. Are you trying to make money? That's the question. Section 7, the smart business owner approach. If you want to protect yourself, keep clean books, separate accounts, have a written business plan, document marketing activity, show attempts to improve profits. If audited, you don't argue. You show documentation. That changes everything. Strong close. So the next time someone says, you can only write off losses for 3 years, you can calmly say, that's not what the code says. The rule is 3 out of 5 for presumption, not permission. Huge difference. Tax law is about facts and intent, not internet myths. Call to action. If you're running a home-based business and want to make sure you're structured correctly, make sure you're operating like a real business. Because when you do, the tax code works for you, not against you.